This is the business Blackbook, where billion-dollar empires are built and collapse. Before we begin, you need to know one number: $112 billion. That is how much money flowed through a company most people had never heard of. A company with no factories, no products, no inventory. Just paper. Just promises. Just the elegant illusion of money moving from one hand to another. And when it stopped moving, the entire financial world held its breath. Here is what they never put in the headlines. The man who built this empire did not steal in the dark. He did it in broad daylight, in front of prime ministers, in front of central banks, in front of the most sophisticated investors on the planet. And every single one of them smiled and signed the check. This is the story of Greensill Capital, the supply chain ghost that haunted the global financial system until the day it simply disappeared. Let us start where all great illusions start, with a problem that actually needed solving. Imagine you are a small manufacturer. You make parts. You supply those parts to a massive corporation. That corporation receives your delivery, signs off on it, and tells you you will be paid in 90 days, maybe 120 days. But you need to pay your workers tomorrow. You need to buy raw materials next week. The invoice is real. The money is coming, but it is not here. And in business, timing is everything. This gap between delivery and payment has existed for centuries. It is called the working capital gap. And for small and medium businesses, it is not just inconvenient. It is existential. Now enter Lex Greensill, a farmer's son from Bundaberg, Australia, a man who watched his own family's sugarcane business struggle with this exact problem. Payments delayed, cash starved, the invoice sitting there like a taunting promise. He understood the pain from the inside, and he turned that pain into a product. The concept was elegant, almost beautiful in its simplicity. Greensill Capital would step in between the buyer and the supplier. When a supplier delivered goods and was told to wait 90 days for payment, Greensill would pay that supplier immediately. Today, right now, the supplier gets their cash. The buyer pays Greensill instead of the supplier. And Greensill earns a small fee for bridging that gap. It is called supply chain finance. And in its purest form, it works. It genuinely helps smaller businesses survive. It genuinely unlocks trapped capital. It genuinely solves a real problem in the global economy. This is important. Remember this, because the best frauds do not start as frauds. They start as something real. Lex Greensill was not some back alley schemer. He had credentials that would make your jaw drop. He worked at Morgan Stanley. He worked at Citigroup. He advised British Cabinet Office under David Cameron's government. He was awarded a Commander of the British Empire, the CBE, for services to the economy. He wore his background like armor every room he walked into. He brought legitimacy. Every conversation he started, he brought credibility. By 2019, Greensill Capital was valued at approximately $7 billion. SoftBank's Vision Fund, the same fund that backed Uber, WeWork, and virtually every tech unicorn of that era, had poured $1.5 billion into the company. The Financial Times called him a pioneer. Business journalists called him the man who was democratizing finance. Heads of state took his calls, but here is where we turn the first page of the Blackbook, because supply chain finance as a concept is sound. What Lex Greensill did with it was something else entirely. On page 47 of the ledger, we find a trick called future receivables financing. Let me explain this carefully, because this is where the ghost was born. Traditional supply chain finance works with real invoices. A supplier delivered goods. A buyer owes money. The invoice exists. The transaction happened. But Greensill began financing something that did not yet exist. He called them prospective receivables, anticipated receivables. Essentially, he was creating financial instruments based on the idea that a company might possibly receive money in the future for goods they had not yet sold to customers who had not yet placed an order. Read that again. He was packaging the financial equivalent of a dream and selling it as a security. Now, here is where the architecture becomes genuinely staggering. Greensill did not just hold these receivables on his own books. He packaged them into bonds. He took thousands of these invoices, real and, let's just say loosely real, and bundled them together into notes, financial products, securities. And then he sold them to investors through supply chain finance funds managed by Credit Suisse. One of the most prestigious names in global banking, running funds worth approximately $10 billion. Funds that their clients believed were safe, boring, low-risk instruments. The clients of those funds? Pension funds, insurance companies, municipalities, institutional investors managing money that belonged to ordinary people saving for retirement. And at the center of this web, sitting quietly, was a single private company with a founder who answered to virtually no one. But that is not even the real story. The real story is a man named Sanjeev Gupta, because Greensill Capital had customers, real customers, and customers that stretch the definition of real almost beyond recognition. Sanjeev Gupta was building something he called the GFG Alliance, a sprawling industrial empire spanning steel mills, aluminum plants, energy assets across the United Kingdom, Australia, Europe. He was hailed as the savior of British steel. When old industrial towns were dying, Gupta swept in and bought the mills, kept workers employed, was celebrated as a hero. But Gupta's empire had a problem. It was almost entirely financed by Greensill Capital, and by the time the crisis hit, GFG Alliance owed Greensill an estimated $5 billion, the single largest exposure in the entire portfolio, $5 billion to one client. One client whose revenue streams were, investigators would later allege, significantly embellished in the documentation submitted to Greensill. Invoices for transactions that were difficult to verify. Receivables from companies that were apparently connected to Gupta himself. Circular flows of paper money that seemed to justify the lending on the surface, while underneath was something else entirely. Here is a question that should haunt you. How does a private company accumulate this kind of exposure? How does this go unnoticed? How do the auditors, the regulators, the due diligence teams at Credit Suisse, at SoftBank, at every bank that touched this machine. How does everyone miss it? The answer is not incompetence. The answer is incentive. When money is moving, everyone is getting paid. The bankers earn fees. The fund managers earn fees. The advisors earn fees. And as long as the machine keeps moving, as long as the invoices keep flowing, nobody has a reason to look too closely at what the machine is actually built on. This is the oldest principle in financial crime. The fraud does not survive because people are blind. The fraud survives because people are comfortable. Now, let us talk about the political architecture, because this is where the story becomes something beyond finance. Lex Greensill had a relationship with David Cameron, former Prime Minister of the United Kingdom. Not a casual relationship, a genuine, embedded, official relationship. Cameron was appointed as a paid advisor to Greensill Capital after leaving office. He had an equity stake in the company. He was, by multiple accounts, personally invested in its success. And when the pandemic hit in 2020 and the British government launched emergency lending programs to support businesses, Cameron sent texts. He made calls. He lobbied Treasury ministers. He pushed for Greensill to be included in government-backed lending schemes worth billions of pounds. Let that sit with you for a moment. A former prime minister using private communications, lobbying a government he once led. On behalf of a company he was financially invested in, trying to route public money through that company's platform. The British government ultimately refused to grant Greensill access to the most significant schemes, but the lobbying itself, the access, the blurring of public interest and private gain. This was not a side note. This was the anatomy of a system that had rewarded Greensill at every single turn. Knighthoods, access, prestige, cabinet meetings, the architecture of legitimacy, carefully assembled, brick by brick. Now we reach the crack. In late 2020, something changed in the insurance markets. Greensill's entire model depended on insurance policies that protected investors in those Credit Suisse funds against defaults on the receivables they had purchased. Think of it as the safety net beneath the tightrope. And in July of 2020, an insurer called Tokio Marine reviewed its policies and decided not to renew coverage for approximately $4.6 billion of supply chain finance notes. The insurer had looked at the underlying assets, and apparently they did not like what they saw. When the insurance disappeared, the entire structure became visible for the first time. Without insurance, the Credit Suisse funds could not accept new receivables from Greensill. Without new receivables, Greensill could not generate revenue. Without revenue, Greensill could not service its own debts. Without the ability to service its debts, the machine that had been moving at extraordinary speed simply stopped. March 8th, 2021. Credit Suisse froze the supply chain finance funds. $10 billion. Suspended. Locked. The investors who had put their money into what they believed were safe, conservative instruments could not access their money. The same day, SoftBank wrote down its investment to effectively zero. Within days, Greensill Capital filed for administration in the United Kingdom. The empire that had touched $112 billion in transactions across 50 countries, serving over 8 million customers and suppliers, was gone. in weeks. But the collapse of Greensill was not the end of the story. It was the beginning of the consequences. Sanjeev Gupta's GFG Alliance was suddenly staring into an abyss. Billions in financing evaporated overnight. Steel mills employing thousands of workers in the United Kingdom, in France, in Australia, suddenly had no access to operating capital. The Serious Fraud Office in the United Kingdom launched a criminal investigation into GFG Alliance. Allegations of fraud, fraudulent trading, money laundering. Credit Suisse, already wounded by the Archegos capital collapse happening almost simultaneously, faced the full reputational devastation of having sold $10 billion of funds built on assets their own due diligence apparently failed to interrogate properly. The bank would pay the price in the years that followed, and David Cameron, he faced parliamentary scrutiny. His private texts to ministers were published. He issued apologies. He acknowledged carefully that his lobbying was not appropriate. The man who had once stood at the podium of the British Prime Minister's office was explaining himself to a committee about text messages sent on behalf of a company that no longer existed. Now, here is the deepest lesson buried in the Blackbook, the one that is almost never discussed. Greensill Capital was not a traditional fraud in the sense of a man who invented fake companies and vanished to a Caribbean island. Lex Greensill believed in what he was building. At some level, in the beginning, the product was real. What happened was something more insidious. It was the gradual expansion of a legitimate idea into illegitimate territory. Each step seemed small. Finance real invoices. Then, finance invoices that might arrive soon. Then, finance invoices that could plausibly exist. Then, finance invoices that, well, someone said they would exist. Each step was justified by the step before it. Each step was lubricated by the enormous amounts of money being generated for everyone involved. And by the time the structure was truly rotten, it was so deeply embedded in the global financial system, so wrapped in the names of prestigious institutions and political figures, that unwinding it caused shock waves from London to Sydney to Tokyo. This is what makes supply chain finance fraud so dangerous. It hides inside the plumbing of real business. It pretends to be the water. And by the time you realize it is something else, it is already everywhere. The auditors who signed off, the regulators who looked away, the bankers who earned their fees, the politicians who made their calls, the investors who asked no questions because the returns were coming and the paperwork looked clean. Every single one of them was a ghost in this machine. Not because they were all criminals, but because the system, the beautiful, profitable, prestigious system, rewarded them for not looking. $112 billion, moved by a company that turned out to be built on air. And the man at the center of it all? Lex Greensill, with his CBE and his SoftBank backing and his prime ministerial connections, failed for bankruptcy. Just another entry in the Blackbook. And with that, the Blackbook closes. Subscribe, and we will open the next page soon.